and welcome to SIEPR, the Stanford Institute for Economic Policy Research. I'm Mark Duggan, the Treasury Director of SIEPR, and I'm very, very grateful that you're here with us today for an event on a very important and I think timely set of topics. Our guest speaker today is Richard Clarida, a former vice chair of the Federal Reserve Bank's Board of Governors and now the Global Economic Advisor for the PIMCO investment management firm. Rich is also, and I apologize if I get anything wrong, and I could go on and on about all of his accomplishments, so I'm going to try to keep it short, is also the C. Lowell Harris Professor of Economics and International Affairs at Columbia University. Given the state of the U.S. and global economy, not to mention the rattled banking sector, exemplified by what we've seen in recent days with First Republic Bank, and the upcoming meeting of the Federal Open Market Committee tomorrow and on Wednesday, we could hardly have a better speaker or a timelier set of topics today, May 1st, 2023. By the way, exactly 10 months from the 2024 SIEPR Economic Summit, March 1, 2024. I know, just so you get that on your radar screen. Friday, March 1, 2024. A hugely important part of our mission here at SIEPR is to connect policymakers and business leaders with our scholars so that each group can learn from the other's different perspectives and unique insights into the most pressing economic policy issues of the day. Richard has worn all three of those hats, policymaker, business leader, and scholar, by the way. We also strive every day to educate the next generation of economic policy experts while supporting the best types of research that will analyze, inform, and shape the economic policies that touch so many of our lives. And we're seeing the impact of many of these policies play out in pretty spectacular fashion these days. And Richard is here to help us make sense of many different areas, and especially monetary policy. We all woke up this morning to the news that the FDIC had taken First Republic Bank into receivership and sold it to JP Morgan Chase, or parts of it. I don't quite understand all the details of that, which I will be asking about. And this comes on the heels of the recent collapse of both Silicon Valley Bank and Signature Bank. All of this will surely be on the minds of the Fed's Open Market Committee when they meet over the next couple of days to decide whether to raise interest rates again and what guidance to give after their meeting about the likely path going forward. Regulators from the Fed and elsewhere are taking some responsibility for the recent turmoil in the banking sector, as we saw just a few days ago when the Fed released a report showing how bank supervision and regulation wasn't sufficiently strong to prevent the collapse of Silicon Valley Bank. And the FDIC also released a report of its own on Friday showing not so great management and lax oversight. Aside from the banking turmoil, the message that is emerging from recent data is somewhat mixed, with some data suggesting the Fed's policies to cool the economy and beat back inflation are beginning to take hold, and other data suggesting the opposite. But it's probably still a pretty safe bet to expect the Fed to make their 10th consecutive interest rate hike when they meet later this week. We have several SIEPR scholars who study these sorts of issues very closely, including Anat Admati, Amit Seru, Daryl Duffy, Monica Piazzesi, Matteo Maggiore, and many others. So it's really, for us, a great fit to have someone of Richard Clarida's stature and expertise with us today to provide his insights into all that is happening. Outside of PIMCO and Columbia University, Rich served as the vice chair of the Board of Governors of the Fed between September 2018 and January 2022, a very interesting time, and was previously the Assistant Secretary of the Treasury for Economic Policy, and also worked as the economic advisor to 2 U.S. Treasury Secretaries. Earlier in his career, he was with Credit Suisse and Grossman Asset Management. So I could go on and on. He's done a huge amount during his career in the, I believe, 35 years since he arrived at Columbia. It was at Yale 5 years before that, correct? But after graduate school. Also on the East Coast, a lot of East Coast stuff, so we're excited to have him out here to the West Coast. And after Richard's presentation, I will ask him a few questions, and then we'll open it up for Q&A from all of you. And especially since I am a microeconomist and he's more of a macroeconomist, I'll especially look to all of you for your questions. So with that, I'm delighted to turn things over to Richard Clarida, and please join me in welcoming him to SIEPR.
Well, thank you for that introduction. It's a thrill to be here. I should offer some context. You know, most people think of this part of the world as being the center of the tech universe, which it is. But in what I work on, which is the intersection of macro and monetary economics and financial markets, this really is the center of the universe. And many of you are friends, and your work has been instrumental in mine. So it's a particular honor to be invited to SIEPR to talk about a very timely topic. I've entitled this Perspectives on Post-Pandemic U.S. Monetary Policy, and I promise in the second half I will get to U.S. monetary policy. But one of my missions today is to provide, I think, some much needed and undersupplied context for the current state of play with regards to inflation and central banking. And so I'm going to start with a global overview of the current state of play with regards to inflation and monetary policy. And then in the second half of my talk, zoom in on the Fed. Okay, so the first thing to note, which is not a deep point, but it's oftentimes missed in some discussions of the Fed, is that a persistent, sustained surge in price inflation is a distinctive and distressing reality of the post-pandemic global economy. This is true in both advanced and emerging economies. I hate that term advanced, but it's the typical nomenclature. This is just recent data from the IMF's World Economic Outlook, and obviously you see a very pronounced surge and persistence in inflation, both in headline and core. Now, this could be a coincidence. It could be that in these 35 countries that the IMF looks at, you just had some uncorrelated shocks that produced the biggest increase in inflation in 40 years. I don't think so. I won't waste your time saying it was a coincidence. But it could mean there are some common factors. And so let's talk a little bit about the common factors. Just to show you this is not particular skewing of the data, let's look at the big three, or at least the G3, the Euro area, the UK, and the US. Sorry, I just put these slides together recently, so the source of this is a recent speech by Catherine Mann at the Bank of England. These are core inflation measures, so they strip out, for example, the effects that the Ukraine invasion had on food and energy prices. And what you see now is that although the US was first, eventually all three of these countries and many more find themselves in a situation where core measures of inflation are at 40-year highs and are very persistently above central bank targets. And so we do want to keep that in mind. Now, what are the common factors? This is not a particularly deep point. In fact, if I were still back teaching principles of economics, which I used to back as a graduate student to support my way through Harvard, I'd talk about both aggregate supply and aggregate demand. So the first thing you have to keep in mind, especially if you're not used to looking at data from other countries, is what is striking if you read the central bank commentary out of Canada, the UK, Australia, many other countries, Sweden, you more or less see the same narrative. And one of the key narratives is that there's been a significant decline in post-pandemic aggregate supply consistent with what central bankers and others thought was the trend potential of the economy going into the pandemic. So we've had this big inflation overshoot in these countries, but GDP levels are still well below what would have been guessed for potential GDP before the pandemic. So I think aggregate supply shifts are clearly part of the story. Secondly, there was a massive fiscal and monetary policy mix of interventions that were put in place in support of aggregate demand in response to the initial pandemic. You know, I was at the Fed between 2018 and January of 2022. Without apology from me, or I think my colleagues in 2020, we were all in. We cut rates to zero. We announced programs to support the Treasury and the mortgage markets. We also announced programs to provide liquidity against collateral to financial institutions. And then the week of March 23rd, we announced that we would set up facilities to backstop the corporate and the municipal bond market. I'm happy to say that just the announcement effect on those facilities was enough to reopen private credit intermediation In the case of the corporate program, we didn't lend 1 penny in the primary corporate program. In the case of the municipal program, we did lend to my home state of Illinois and the Metropolitan Transit Authority. Similarly, there was a huge fiscal response, not just in the US, but globally. In the case of the US, we had 3 fiscal packages between March of 2020 and March of 2021 that totaled $6 trillion or 20+% of GDP. This data from the IMF also shows you that you had big fiscal responses across most jurisdictions, big expansion in central bank balance sheets. Central banks cut rates, those central banks that could cut rates in 2020. Central banks in the Eurozone and other countries were effectively at the lower bound, but those central banks like the Fed that could cut rates did, and then obviously more recently have begun to increase rates. The third factor, which I think is not a deep point, but it's often misunderstood, in part because macroeconomics in the US oftentimes has evolved in the context of what we call one good models, which ignore relative prices. But in any economy, there are more than 2 goods. Those of us who work in international macroeconomics, and I see Bob Hodrick here, are always used to thinking about relative prices of imports in terms of trade. But the key big relative price adjustment that was part of the pandemic reality was a big increase in the relative price of goods to services. And again, this is a chart taken from the Bank of England that shows you this reality. The important point, and I'll speak now about the US experience, is indeed, I remember vividly having conversations with Jay Powell about this early on in my time at the Fed, is that in this period, the great globalization period from the early 90s till the pandemic, a stylized fact in the US was because of globalization and supply chain optimization, the absolute dollar price of goods was actually falling. So we actually had goods deflation, running about, on average, about -1% a year. And services inflation was running about 3%. So in a year when the Fed was close to its 2% inflation target, services were inflating at 3% and goods were at -1%, and that's how the Fed got more or less to 2%. So the relative price adjustment has actually been part of even the pre-pandemic experience, but it was often ignored. Now, in the US, you can actually see the skewed composition of consumption of goods versus consumption of services. So goods are here, services. You see that before the pandemic, they're both trending up at a similar rate. Now, it's easy to understand this at some level. During the darkest days of the pandemic, folks were not eager to go to partake in a lot of contact-intensive services. The government was sending out a lot of checks. We cut rates to 0, so people who could get out would buy a car or buy an appliance or whatever. So that's clearly, the direction of this is certainly not something that took us by surprise. But the magnitude and persistence of this effect has certainly lasted a long time. And of course, in the background here, you've got very significant supply disruptions because of well-known challenges in international supply chains. Now, this is the one equation in the paper, and I'll just talk through it in words. Team transitory, and I will confess I was a charter member of Team Transitory, maybe a little anecdote on that. The term that the Fed expected the inflation to be transitory appeared, I believe, in our March 2021 FOMC statement. And at the time, I and my colleagues actually did not think it was that big a deal because that was in the Fed publishes its forecast 4 times a year. And our forecast was that inflation by the end of 2021 would be back close to 2%. So we just thought we were putting in words what was already in our forecast. Anyway, that proved not to be a very good prediction. One thing I would like to clarify is explicit in our thinking, but I think implicit in our communication, was the recognition that when you have a big relative price adjustment in the economy, as it's playing out, it will show up as inflation. But once it's done, it doesn't necessarily lead to ongoing inflation, and that was a lot of what we were trying to get at. Now, of course, in a world with fully flexible prices, you can have both relative price adjustment and constant price levels, but that requires essentially the nominal price of services to decline in absolute amount, and the Fed and other central banks were at that time not willing to tighten policy to reduce the price of services. I want to now provide some facts. I said I would Google this. I haven't, but someone once said facts are stubborn things. I think in particular with regards to discussion of post-pandemic inflation, these facts are either overlooked or ignored, and I think they're quite important. So I'll give you some facts. I won't go through each line item in this table, but they all, believe me, they all support what I'm about to say. So the first thing, which we've already seen, inflation in advanced economies is well above inflation targets now 3 years into the reopening. And importantly, core inflation in advanced economies is well above inflation targets now 3 years into the reopening. The only exception to this is it's barely above target in Switzerland, and Switzerland, I'm not sorry, in Switzerland, yeah. And I'll come back to that in a moment. But for example, you see core inflation now in Canada is at 4.4, 4.9, the Eurozone running well above target. And so this is not just a US phenomenon 3 years into the pandemic. We have these Six Sigma overshoots in core inflation. What I think is also relevant, and here I'm sure John will take notice, is that no advanced economy's central bank began to hike rates until inflation exceeded target. So as you had no central banks acting preemptively to begin to hike before inflation got to target. Now, if you look at inflation on a core basis, so you say, what about central banks hiking relative to when core inflation exceeded target? Of the 9 central banks here, 7 delayed the first hike until core inflation was above target. So it's some deep sense, and maybe not at present, but in the future, future monetary historians will want to look at this collective choice by central banks to delay their first rate hike until core inflation moved above target. I should point out here that there are 10 countries in the typical advanced economy list, which include Japan. Japan, of course, is an advanced economy. I leave them out. They would help me to make my case. But in Japan, and we'll hear from former Governor Clarida at Stanford in a week or so, who will be here. In Japan, they actually wanted inflation to move above and stay well above 2%. So they actually chose not to hike for that reason. This is just an essay. There are plenty of other central banks that have sort of tried to begin their own post-pandemic analysis of this policy delay. So these advanced economy central banks are all inflation targeters. And the Fed adopted an evolution of inflation targeting in August of 2020, flexible average inflation targeting. I will come back to that more in a moment. So if the documented inflation overshoots and the choices to fall behind the curve represent a framework failure, they represent failures, at least in this instance, of both inflation targeting and flexible average inflation targeting. Now, I will argue that I don't believe that's the case. I believe these ex-post monetary policy errors were errors of tactics, not of strategy. And to paraphrase the very colorful and I think accurate quotation of my dear friend and former Fed colleague Randall Quarles, tactical misjudgments in the fog of war. And I will come back to that more in a moment. Now, at this point in the talk, I want to transition from a review of the global evidence to excerpts from a case study that I've written about recently to talk you through a little bit about the perspective of this from a Fed official. I initially thought of entitling this section of What Were They Thinking? It then occurred to me that I do need to respect the fact that within the Fed system, transcripts of deliberations only come out with a 5-year lag. So I've instead entitled this, What Did the Fed Know and When Did They Did It? And I will tell you what I was thinking, which of course I can discuss freely. So a couple of facts are relevant here. The first is that the Fed came into 2021 believing that there was a very significant and sizable output gap. The difference between the level of GDP and potential, and you can obviously see that here. The Fed also came into the year 2021 thinking there was a lot of slack in the labor market. The Fed thought that the rate of unemployment consistent with full employment was around 4%, and we entered the year 2021 with the unemployment rate at 6.7%. The Fed also came into the year realizing that in 2021, underlying price inflation had fallen. So if you think of the pandemic in 2020, it was really a huge once-in-a-century supply shock. We essentially chose to shut down big parts of the economy and the global economy. And a huge demand shock, the big fiscal package that I talked about and the Fed going all in. The net effect of this huge supply shock and demand shock in 2020 was that inflation fell. And wage inflation drifted down as well, although compared to prior downturns, it was actually a pretty modest reduction in wage compared to prior downturns, as you can see. So I would argue through the July FOMC meeting, July 21 Fed meeting, if you came into the year as a Bayesian with a prior, that there was excess, that there was slack, inflation expectations were well anchored, then if you came into the year with that prior, the data that the Fed had, I would say through the July meeting, was not sufficiently inconsistent with that to cause you to change your views. I'll get in a moment to risk management considerations here. But what this chart shows is that very quickly the data went hockey stick, both in price inflation space and wage inflation space. So what I'm showing you here is the Dallas Fed Trim Mean Price Index. You might say, well, why not the traditional indexes, core PCE inflation, for example. And the reason simply is because of the relative price adjustments of goods and services, we actually, at least speaking not only for myself, but some of my other colleagues, began to focus more on measures of underlying inflation that were less subject to picking and choosing. I still vividly remember as a graduate student at Harvard in the 1970s, one of my professors, this is back when inflation was running at 10 or 12% before Volcker came in and saved the day, talking about measures of core inflation, referring to it as, quote, the one damn thing after a number theory of inflation. So in March it was airfares, and in July it was gasoline, in April it was something else. And so we wanted to discipline our thinking about underlying inflation by looking at other measures, and one of these is a trim mean measure. But it really doesn't matter whether or not you're looking at price inflation measures or wage inflation measures. Everything goes hockey stick in the third quarter of 2021. So whatever your Bayesian prior was before then, by that point you've seen enough information to realize that there are some pretty significant changes in the post-pandemic economy. So to me, I think the one thing that I'd say that I think is very straightforward, and as I alluded to earlier in the talk, I think also relevant for most other advanced economy central banks, is that the Fed simply at minimum got post-pandemic aggregate supply wrong. Price inflation picked up with GDP percentage points below contemporaneous estimates of potential, and with the unemployment rate still well above the thinking on full employment, and also with prime age participation still well below the reality of where the economy had been pre-pandemic. Now the Fed's critics, and I would mention here both Larry Summers and Jason Furman, whom I both respect and know, and who are friends, pointed out contemporaneously that there was enough evidence by the spring of 2021 that the Fed should have known that there was also an imbalance between aggregate demand and supply. And we can discuss that, but at minimum, the post-pandemic supply side of the economy began to show inflation picking up well before what one would have expected. Again, I mentioned this also about wage inflation. So now, fast forward. Now, there's a talk at Stanford, so you know I'd have to get into Taylor rule here, John. So here it is, and I'll get it in a couple times. So I've gone from what did the Fed know, when did they know it, to what did the Fed know and when did they lift off? Well, we all know the answer to that. The Fed lifted off formally in March of 2022. And as I alluded to last year in some remarks at the Hoover conference, and I think an important point here is that the Fed had offered forward guidance throughout this period in 2020 and 2021 that it would follow a sequence of tapering QE first, then hiking rates, then shrinking the balance sheet. And the reality is that it chose to honor this guidance, which in effect meant that that commitment to honor that guidance did delay liftoff. As I've said, if you were just looking at the inflation and labor market data without reference to that guidance, I think it would have been clear to have lifted off by the fall of 2021. The important point here, and this is a point that's been made by a former student of John's, David Papel and Roxana Pradhan, in a series of papers that they update. Counterfactuals are always difficult, so we'll never know what the Fed would have done under other circumstances or under inflation targeting. But what we do know is what other central banks did under their inflation targeting frameworks, and we do know what the Fed would have done if it had simply been following an inertial version of the Taylor rule, and that's what's shown here in the dashed line, and that would have had the liftoff, as I said, in sometime between the second and third quarter of 2021. So the Occam's razor version of what the Powell Fed ended up doing, and I should say I've not talked to Jay Powell about this, but my own inference as a former official is that the Occam's razor version of the Fed liftoff since last spring has been a very accelerated, fast-forward version of getting the policy rate up to in the range of a Taylor rule, given the Fed's own projections for where the economy is going to evolve. And during the Q&A, we might get into this. An important point that's almost always overlooked, so I'm not going to overlook it, is that the conditions that the committee laid out in its September 2020 guidance for lifting off rates were actually met by December of 2021. So the Taylor rule would have the Fed lifting off sometime between July and September, and the Fed's conditions for liftoff under its new framework would have had the Fed lifting off in December of that year. But we're really just talking about a matter of months. So will it work? Well, I don't have a crystal ball. Let's talk about the affirmative case and then talk about the risk. So I do think inflation has likely peaked, but the Fed itself projects in its SEP that the unemployment rate will need to rise by at least a percentage point from here in their models to push down price inflation below 3. Up until now, we've had a decline in both price and wage inflation from the peak without any potential softening in the labor market. But I do agree with the Fed projections that getting inflation down from 7 or 8 to 4 is probably going to be easier than getting it down from 4 to 2 point something. I have been in the camp, I think I articulated at last year's Hoover conference, that I think of the destination in this cycle as what I call 2 point something. I think the Fed would love point something to be 0.1 or 0.2, but it may be somewhat higher. The challenge from a risk management perspective is that all the risk on inflation never say all, but a lot of the risk to inflation are to the upside from here. There are different measures of underlying inflation. This is based upon some work that Deutsche Bank pulls together that's quite convenient. They essentially have up and running about 10 or 12 time series signal extraction models of underlying inflation, and what's shown here in the lower 2 lines are the average of these statistical models, and they all have underlying inflation running somewhere in the mid-3s, if not higher. Also, as I've said, we still have, if you look at vacancies, a pretty substantial imbalance in the labor market between vacancies and availability. So I'm in the camp that sharing with what Jay Powell said at Jackson Hole last year, that some pain in the labor market will probably be required. If there is a silver lining to what has been a challenging period, inflation expectations do appear to be well anchored at or close to the Fed's target, at least at medium-term horizons. And this is true whether or not you look at break-even inflation in financial markets or you look at inflation in surveys and the like. I've got 3 more slides, and then I'll finish up for Q&A. So the Fed obviously not only cut rates to 0, but as with other central banks, the Fed purchased trillions of dollars of Treasury securities and mortgages between March of 2020 and March of 2022. The important point about QE in practice is that central banks do it when they're at their effective lower bound. So essentially, you're actively doing QE when rates are zero. And to many, this appears to convey the idea that QE is a free lunch for the government or the fiscal authority, because you're buying a security with a positive coupon and you're financing it with bank reserves that at the time pay close to a zero rate of interest. But importantly, and indeed the Fed would not have done QE under Bernanke, Yellen, and Powell, but there was a change in the legislative language that allowed the Fed to pay interest on reserves beginning in 2008. I wrote a recent piece in The Economist in the by invitation section going through this in some detail. But the basic thing about QE is that although QE appears to be a free lunch, what in essence it does, and now I'm channeling John Cochran, I don't know, John, if you're here, but I'm channeling my inner John Cochran. What QE does is it's essentially changing the maturity composition of a given quantity of government debt. It's not shrinking government debt. You're not extinguishing coupon payments. You're just exchanging a fixed coupon payment for a floating rate payment, because the Fed's now raised rates on reserves close to T-bill rates, which are well north of the coupons that it replaced. And so I think that's also important as you think about the way that QE is impacting or not impacting the economy. And I'll just leave this as a point, because I don't want to get pulled in and go over my allotted time. But I do think a big elephant in the room, and Daryl is now, I'm sure, will have a comment either now or over dinner, is the reverse repo facility. Now, this is very much in the weeds, but give me the 30-second version. Is the Fed set up this facility about a decade ago to deal with the situation when rates were close to zero, and it wanted to prevent T-bill rates from going negative. So it essentially enables money market funds to lend money to the Fed. And arithmetically, when that happens, they're draining reserves from the banking system. Now, in the last iteration of QE, this facility basically went to zero and was not really used by the time the Fed began to hike rates. Now the funds rate is close to 5%. It probably will be on Wednesday. And this facility is now about $2 trillion. So an important point about the plumbing of the U.S. financial system is whether or not having a huge piece of liquidity moving in and out of the banking system of this scale is something that is a feature or a bug. So in conclusion, persistent sustained surge in core inflation is a distinctive and distressing feature of the global economy. I think it reflects combinations of a policy response, delayed withdrawal of policy stimulus, and shifts to aggregate supply. With the exception of a handful of countries, Switzerland and Norway, all other advanced economy central banks delayed rate hikes until core inflation exceeded target. I don't think it's a failure of framework, but a failure of execution, and I will share with Corals, perhaps in the fog of war. And I thank you for your time and attention, and I look forward to my conversation with you and with Mark. Thank you.
Thanks so much, Rich, for the remarks. And I'm just going to ask you a few questions and then open it up. The first one, just high level on monetary policy, and then we'll go a little bit perhaps into the bank.
Yeah, let's do it.
Okay, great. So just at a high level, obviously a huge amount has happened over the last 3+ years. You were at the Fed at the beginning of the pandemic. You've covered it here, but just stepping back without figures behind you, just at a high level, obviously there's an element of sort of hindsight is 20/20 kind of thing, the fog of war, but are there places when you look back at the sort of trajectory of the federal funds rate, interest rates, and the balance sheet where it, in hindsight, even given the available information, it looks like it wasn't optimized? So I don't know. And what overall grade would you give the Fed over this 3+ year period? It's a very hard time, right?
Yeah,
so,
well, look, I'll just leave you with one anecdote. There have been a couple of recent books published which have shared the details of this meeting, which are accurate, so I can share it with you. So in the last week of February, Jay Powell
2020
2020 called a meeting This is before there had been a diagnosed case of COVID in the U.S. from local transmission. Some folks had picked it up on a cruise ship or whatever. And I had given an interview on CNBC a week before, at that point reflecting my thinking, which was that COVID would likely impact the global economy because it would shut down China. But at that point, at least I and I think some of my colleagues didn't appreciate how quickly it would become the enormous hit to the global economy that it was. And so he did a quick tour of the staff going through different scenarios. And he looked at me and said, so Rich, under the worst case scenario, is this the global financial crisis? And I said, no, Jay, under the worst case scenario, it's the Great Depression. And I wasn't exaggerating because ex ante, the idea that you would shut down the US economy for an unknown duration, how do you think of operating a financial system if companies have no revenues to make coupon payments, loan payments, to pay their workers, or to pay the leases on their office space? Do you simply allow the US financial system to collapse because through no fault of their own, companies can't open? So I do think it was appropriate to go all in. As I mentioned, I gave examples in the talk. I won't revisit them here. I'm very proud of the fact that when it became clear the announcement effect on these facilities was sufficient to reopen private sector financial intermediation, that we unwound the facilities very quickly. But I do think the backstop was important. So I would give the Fed an A for 2020, and I will leave it to other professors to grade the performance since then. But no regrets or apologies for going all in 2020.
Right, 2020 was a very scary time. Okay, so fast forwarding a bit to more recent times, obviously during the pandemic, there were lots of changes in the economy that happened. The stock market took a gigantic hit initially in the spring of 2020 and then surged back remarkably, and financial markets did really well. We saw huge changes here in Silicon Valley, and perhaps most spectacularly, looking at, let's say, the deposits at a place like Silicon Valley Bank, they just grew massively.
Yeah.
And that was an interesting time, and obviously since then, over the last 15 or so months, there's been a pretty big change in the yield curve and interest rates that changed the situation for these banks. Can you walk us through a little bit how you see what happened with Silicon Valley Bank, with First Republic Bank, I guess Signature, and maybe they differed somewhat, but maybe you can tell us a little bit about that. And the role of the Fed in all this, and regulators.
Yeah, so, and I want to keep this at a pretty high level because I do think that the details are important, but I think there are certain inferences you can draw and sketch out a big picture. So the first thing to remember is banks are in the business of doing maturity transformation, usually. Now, a bank could always operate, take deposits, and invest in T-bills, or since 2008, invest in bank reserves. But I used to teach money in banking, bank in those simpler times when Volcker was disinflating the economy, and Continental Illinois went under, which at the time was the biggest bank failure. So banks are in the business of doing maturity transformation. So the fact that in an aggressive rate hike cycle, banks will have assets on their balance sheet that go down in value and higher rates, that's just part of the risk and reward of banking. So when SVB happened, I would push back when I would have conversations with colleagues or others about whether or not you should focus on the fact that SVB's losses were in the Treasury and the MBS portfolio. They were just losses on doing maturity transformation in a rising rate environment. First Republic challenge was traditional. They had a lot of mortgages that lost value at higher rates. So I think in some level, rate hike cycles always have elements of that. I mentioned Continental Illinois, the savings and loan episodes in the late 80s or early 90s. I think there are a couple things here that are worth noting. There's a very prescient speech that was given by Martin Grunberg, who is the chairman of the FDIC, in, I believe, the spring of 2019 at a Brookings event. And it's really striking when you read it. What Grunberg said in that was, look, we've had a lot of reform, the big systemically important banks, resolution, we've got that figured out. I'm paraphrasing now. We have a lot of small banks. Okay, small banks, the good news about being small is that they're pretty straightforward to resolve, and the FDIC has a 75-year track record at taking a tiny bank in Heron, Illinois, where I grew up, and selling it to another tiny bank in Alton, Illinois. I mean, that's what they do. But he said the challenge we have is we're not particularly really good at banks in the middle, that they may not be J.P. Morgan or Goldman Sachs, but they are difficult to resolve in a weekend. And I think that's exactly what we saw with SVB. Now, some certain special other situation, the fact that 98% of the deposits were uninsured should have been a red flag to anybody. Also, the common denominator is, regardless of the maturity transformation bet that you make, both of those banks had unrealized losses that essentially wiped out their equity. Now, getting to the Fed, what I will say, again, just based upon the report we saw last week from the Fed, and then we saw a report at the same time from the General Accounting Office, clearly a breakdown, obviously a breakdown in management of these banks, but importantly, a breakdown in, I believe, the way that the process should work when banks do make bets that go south, and in particular with regards to elevating concerns when there's documented case history of liquidity and risk management being insufficient. So we don't have time to weigh into the 2018 and the tailoring rules, but I will simply say that as a Fed official, and from 2018 to 2022, I endorsed those proposals and the idea of tailoring precisely because I thought it was best to deal with banks on a bank-by-bank basis, and clearly I think that did not work as it should have in this case.
Okay, great. So thanks for that, and I'm sure others here will have more questions for that. I'm just going to circle back to monetary policy looking forward, because we have this meeting coming up tomorrow and Wednesday, then open it up for more questions from others here. So I think the consensus appears to be, you would have your finger on the pulse of this better than I would, that the rate on Wednesday is likely to go up another, let's say, quarter point. Going forward, I think it sounds like it gets murkier. Can you walk us through a bit how the forks in the road that people on the FOMC are likely to face as they think about this decision? If inflation remains high, how high are they willing to go, and whatnot?
So I have thought for really since the fall that would appear to be the, if you will, the bargain struck. I mean, Jay Powell's done a remarkable job of holding together a pretty diverse committee in moving in a very hawkish direction. And I did begin to detect in the fall, and wrote about this, and when I go on TV talked about it, that it did appear to me that the Fed was signaling that they were going to move in 2023 to a stance that was less high-frequency data dependent and more to a position where they wanted to get rates up to the level that they believe should be sufficiently restrictive, and then pause, not to declare mission accomplished, but merely to acknowledge that monetary policy operates with lag. Now, if we get that, and I think that's the most likely scenario, that can be challenging to communicate, the distinction between a pause and the Fed being done or the Fed cutting. But from all their public comments, I think it's a legitimate pause. I don't think that it's mission accomplished. They don't think it's mission accomplished. Underlying inflation is at least a point too high. But the bet is that the cumulative effect of this policy, and then in addition to that, and I think that the chair said this very concisely in the March meeting, that there's going to be incremental tightening in financial conditions from banks, either because of regulatory or stockholder pressure to have more liquidity. And if you're a bank, and especially if you have securities you don't want to sell, easiest way to raise liquidity is to slow the growth in your loan book. So I think the combination of what's in place and additional tightening, they believe, will slow demand to get inflation down. I think the challenge for the Fed will be if a year from now we're sitting here and underlying inflation is not budged, it's going to be a tough choice. I think in the end, I take Jay Powell at his word that he and they will keep at it till the job is done, but that is a risk scenario. On the other side, I think all distributions, you have to remind yourself when you're doing this both as an investor or a finance professor or as a policymaker, almost all probability distributions have two sides around the central tendency. So there is a case in which inflation does come, once the labor market does begin to slow, and once the delayed effect of policy come in, the inflation may come down more rapidly than the Fed expects, and I think that would be a good problem for them to have. So I think they will pause. I think they will try to communicate this as a pause. I think they hope they're done, but if it turns out inflation's stickier, then there's probably another leg up in rates.
Okay, great. All right, so now I want to open it up for questions that I would just ask. If you do ask a question, could you just identify your name or what have you? But here we have a question right here. Your name?
Hi.
You can stand up. Can we get the microphone to? Yeah, let's try to get the microphone.
Yeah, my name is Gonzalo Silveira. I'm managing a single-family office in Silicon Valley. Do you think it's realistic for the Fed to continue to beat on the drum of the 2%? It won't be instilling more confidence going 3%? You mentioned 3.5 something now.
So you're talking about the formal inflation target. So I'll start with what I think they will do, and then talk about what they should do. So I do believe, and I think here there's an imperfect analogy between the Fed in the 04 to 06 cycle. I do think they're going to pause. Well, I'm almost positive they're going to pause rate with inflation above the desired level. In that cycle, they paused with inflation running about 2 3/4, and obviously now higher. And there will be a lot of talk when they do that of essentially redefining the target of policy to a higher rate of inflation. I don't think they'll do that because Jay Powell's been asked that question several times, and when he's asked, he says no. And the reason I think they won't do it is the following. I think you can make a case that with a clean sheet of paper, there's nothing particularly magical about 2, 2.5. I think nobody would sign off on 4 or 5. Although John had a big influence in the 1993 paper of writing down 2. But ex post, there is significant path dependence on this decision. One of the reasons we are where we are is that the bond market does think the Fed, at least over the next 5 years, can eventually get inflation down close to 2. So ironically, a lot of the supporters of raising the inflation target say, oh, it would be a great idea, you could stop sooner, but it would be a great idea until the bond market figured it out, and then you'd have a big sell-off in bonds and in mortgages, and it would slow the economy even further. So there is a bit of is what mathematicians or economists call a fixed point in terms of this equilibrium. And so for all those reasons, I do think that and indeed this is in the Fed's projections, that they think they can begin to bringing policy rates down to a more normal level if, as they expect, inflation begins to fall. But I don't expect them to formally increase the inflation target.
Okay. Next question, we've got David right here. So, can we get a microphone, and then we'll go back here to Amit, and then to behind him. David Lichtinger.
Thank you for your comments. I'm David Lichtinger. I have a real estate private equity firm. So, Richard, what's your view when you look at this monetary fiscal mix of causing inflation? I know what John thinks, but do you think it was more on the fiscal side that really brought the inflation out, or do you think it was monetary policy? I personally think the fiscal side had a lot more, but John would take the other side of that. So where do you on that?
Well, I think what I would say is you had a 6 sigma fiscal response and a 6 sigma monetary response at the same time. So disentangling that's going to be hard. I think in my own mind, when I think about both the fact that doing a lot of QE did not trigger a lot of inflation before, and the fact, as I showed, you had substantial fiscal in this cycle. I certainly do think fiscal was part of me. The thought experiment would be, suppose the Fed had done no QE, but you had had the $6 trillion in fiscal. I think we would have had a lot of inflation. Go to the other thing where we have no fiscal, but the Fed is buying a lot of 10-year treasuries. And my friends who we'd always talk about pushing on a string and interest elasticities So I think it's difficult, and I think there's a range of views, but my own view is that fiscal is a big part of it. And in particular, in the US, because the rational response of households was to save. Of course, we had $2.5 trillion of excess saving. So in some ways, I think we were overstating fiscal stimulus in 20 and 21 because folks were saving it. But then in 2022, a lot of that saving was drawn down. So it's almost as though you could think of having fiscal policy in 2020 and 2021, which had been smaller, and then a big fiscal stimulus in 2022 when it obviously wasn't needed. So I do think fiscal is relevant, but doing the precise accounting is probably going to be challenging.
Okay, next question, go with Amit next. And can we get him a microphone? Is that, yeah.
Hi there. I'm Amit Seru. I'm a professor of finance at the Graduate School of Business. Thanks for your talk. So I want to ask you a micro question. You've spoken quite a bit about macro. If I look at the Silicon Valley Bank or the First Republic Bank situation, one rhetoric is it was a liquidity problem and we've fixed it and we'll move forward. I beg to disagree. I think this is a solvency problem. If you look at what kind of securities or assets these banks are invested in, they are pretty liquid, transparent kind of securities. Their value is depressed. If you were to believe estimates, and there are many estimates, including some that I and my colleagues have calculated, we are talking about hundreds of banks which are in similar situation. And one approach is to say that we'll just wait it out, but it doesn't seem like the interest rates are coming down, at least in the short run,
Right.
because we still have an inflation problem. Like you mentioned, if you have to resolve these banks, buyers are going to be hard to find because all the buyers are also lingering around with depressed assets. And I'm worried that we are going to be in a situation which reminds one of Saving and Loans Part 2, where the first few tremors, we provided some protection and said, everything is fine, let's move on. And then that laid the seeds for huge amount of moral hazard and risk because you had a bunch of insolvent, not illiquid, banks in the system. And it's exactly the same situation. I'm kind of surprised by the report by Michael Barr, where he used liquidity 300 times in the report, and solvency was mentioned once. So I just want to hear your thoughts on how you see this tricky situation getting resolved.
Yeah, well, I've certainly followed your work and respect it. I start with the observation that from the top down, the banking system as a whole is profitable. It has adequate liquidity, but the allocation is obviously not uniformly of that way, and that's why I highlighted the speech by Grinberg, because I really do think that, what is it that surprised me about that? It's how prescient that it wasn't implicitly as a macro person. Implicitly, I think the bargain for bank resolution has been that, as I said, you got the three buckets. You've got the too big to fail folks, and now they're actually acquiring deposits because they implicitly have that, that too big to fail ability to attract funds. And you got a lot of small banks, most of their deposits are insured, and they're small enough to resolve. And because the system as a whole is profitable, you can do it. But I don't disagree with you. What is the going concern business model of banks in that middle category? Many of whom, not all of whom, many of whom are, in order to maintain their current balance sheets, would have to pay rates on deposit that generates losses. I think I have more confidence about the destination than the path. The destination is fewer banks. But I do think a challenge is that, and I, not to date myself, but I will since Mark already did. My first job in Washington was as a staffer at the Council of Economic Advisors in 1986. So I was actually there, as a staffer watching the whole savings and loan thing. So in that case, you actually had an entire intermediation sector that in the aggregate was under water. And there was about a decade of kicking the can down the road in that one. I don't think it's comparable in that sense. I think in the aggregate, if you had the planner who could allocate capital across banks, there would be enough to go around. I think the challenge now, as I mentioned, is the challenge of resolving banks in this group that probably don't have going concern business models. And so in that extent, I would agree. For those banks, it's probably not so much liquidity.
Okay, next question behind him, and then not, and then in front. Yeah. Give your name. Yeah.
Yeah, hi, I'm Dhaval Shah. I'm an alumni working in the machine learning AI space. The question I had were two-part. One was with respect to Fed independence. Obviously, you spent so much time there, so wanted your perspective on the aspect of course, when you are making policy decisions, you are taking into account the impact of the fiscal policies, the impact. If something happened because of it, you may want to consider if that's causing inflation, then you may increase rates faster or whatever. But how much do you judge it based on the present impact which is seen versus your projection of what certain policies they did that may create certain impact in the next few years? What is the trade-off there, and how do you figure that out?
You mean with regards to fiscal?
With respect to, the monetary policy that you will make based on whatever the fiscal policy was passed. In terms of the current impact and the future projected impact. And that's a judgment call, I guess, right? So how do you folks reconcile that? That's one question. Second one was on the job owning and signaling with respect to controlling the wealth effect. So how, that's also a bit fuzzy, like you folks try to do that. How do you think about those things? Thank you.
Okay, so on fiscal, what the Fed says, which is actually has the virtue of being true, is that it takes fiscal policy as an input. Obviously, the Fed understands that its ability to get inflation to 2 reflects in part what fiscal policy is in place. That said, in the past, if you look at the history under Greenspan, Bernanke, and Yellen and Powell, there have been times when Fed officials do weigh into fiscal debates, typically not on the line items in the bill, but on the need for support. Ben regularly during his second term talked about the fact that there was a fiscal headwind to the recovery, and obviously Powell and even his vice chair occasionally, when asked, would say fiscal support was needed in 2020. So it's not a clean line. But I think that, as I said, now that the Fed is in the mode of doing what it takes to get inflation down, if there's too much fiscal in the pipeline for that, it'll just mean higher rates.
Okay, I'm going to try to get 3 questions. So you've got to give your questions really quickly, and you're going to try to answer all 3, and I don't know how they're going to fit together.
Okay.
We've got Anat, then we've got right here, and then we've got John. Anat, you first? We're like a long time.
Hi. This is Anat Admatif, also from the Business School Finance Group. I just want to pick up quickly on what you answered to my colleague Amit here. First of all, you were saying they're not kicking the can down the road, but I think overlending to potentially insolvent banks overvalued collateral is kicking the can down the road and taking risks. So that's number one. Number two, you seem to be accepting the too big to fail thing, what the Fed under Dodd-Frank was told to take care of under its regulatory mission over every systemic institution and actually every bank holding company. So why is that suddenly okay to have a few monstrous banks that are too big to fail?
Okay, let's do that. And then we've got a question right here. Right, so the microphone is right next to you.
My name is John Harley. I'm an econ PhD student. Good to see you, Rich. And I'm just curious, like a simple question. Your colleague, Randall Quarles, recently in a Macro Museums interview said that that the FOMC should have started raising rates in October of 2021, which is sort of when it became clear that it wasn't just sort of the inflation story wasn't just a used cars sort of story, and that shelter prices were going up at that time. Shelter and housing consumption part of housing is like 30% of CPI. I'm curious, do you sort of agree with that assessment, or do you sort of agree that at the time, knowing what you knew then, it still made more sense to wait until when the Fed eventually raised rates in March of 2020?
No,
you got to remember that. Okay, we got John. We got to get John, and then we're kind of out of time. But it is like, how can I say no to the the big guy. I mean, he's.
So thank you so much for the clear exposition. I can't help but stare at your slides where you're finished.
Okay.
You end with, believe it or not, the fog of war, but somehow fog of war is not the thing I'm thinking about. No central bank raised their rates, no headline inflation exceeded target, just a whole long list of behind the curve stuff. You didn't address that, but maybe that's our whole problem. Why can't you think about that as a possibility of what went wrong?
Oh, well.
Okay, so good luck to you. You answer.
I'll,
We got no time either, so I don't know how it's going to work.
no, I'll go in reverse order. I hope if I was ambiguous, let me be clear. Ex post, it certainly turned out to be a problem, and certainly ex post, the outcome we've had is not as good as the outcome we would have had we just essentially lifted off according to the rules-based path. So on that, actually, we can double dip because I'm completely with Randy. And as I mentioned in my own remarks at Hoover in January of 21, in my own mind, that would have been the cleanest way to implement our framework. So that I don't think there's any, I don't want to be ambiguous about that. What I would say, however, is I think the charts are pretty clear that we're really talking, about, we're talking about months here, not years, and we want to put that in the context of the nature of the overshoot and the destination. But no, I agree with that. And then with Anat's point, I said too big to fail is just a reality of where we ended up post Dodd-Frank, and I think what we saw with Credit Suisse is a great example. So there was a whole playbook at the international level of how to resolve a GSIB, and what did the Swiss authorities do? They threw it out. They said, screw it. This is what we're going to do. We don't want to be the first mover. And so I think, in effect, we have now seen that is the reality of the post-Dodd-Frank landscape, is that no policymaker, I shouldn't say no, a very informed and professional group of policymakers did not want to go down that road in resolution. So.
Well, let me just wrap up by saying you're going to get an invitation in a couple days for an event, an upcoming SIEPR event, about the debt limit. And that is going to be an exciting issue that we're all going to be hearing a lot about. So please be on the lookout for that. May 31st will be that event, Wednesday. But please join me in thanking Richard Clarida for sharing his insights today.